Welcome to the deep dive. Today, we're tackling something that, well, it touches pretty much all our wallets. Borrowing money.
That's right.
You know how it is you see that monthly payment number? And sometimes it feels like that's the whole story.
Yeah, it can be really tempting to just focus on that.
But trust us, focusing only on that can really paint a misleading picture.
It really can. It's kind of like seeing a really catchy headline, but then the actual story, has a lot more detail, maybe some hidden catches. That small monthly payment might hide the real size of the commitment.
Exactly. Take Michael's story, for example. He was pretty thrilled about getting a new car. The dealer quoted him, I think it was 3.9% interest.
Sounds pretty good on the surface.
Yeah, sounded sweet, right? He was probably already imagining road trips.
Uh-huh.
But then when he actually looked closely at the loan papers, the annual percentage rate, the APR, was actually 5.2%.
Ah, okay, that's a jump.
It is, and that seemingly small difference, it added up to about, what, $1,200 extra over the life of the loan? Yeah. That's a serious chunk of change that just wasn't obvious from looking at that initial interest rate alone. Makes you wonder, what else you might be missing.
Michael's experience is, well, it's a perfect illustration of why we really need to dig deeper than just that headline interest rate. There's a much bigger picture when you're borrowing.
Absolutely. So in this deep dive, our mission is really to equip you with the knowledge to decode those key loan terms and costs. We want you to be able to see past the interest rate
Right.
and understand the real cost of borrowing.
Because, at the end of the day, being properly informed, that empowers you, lets you make smart financial choices and hopefully avoid those unexpected costs that can sneak up.
Okay, so let's unpack this. Maybe start with the annual percentage rate, APR. You hear it thrown around, but what's the real lowdown?
Okay, so think of the APR as the total cost of borrowing money for 1 year, and it's expressed as a single percentage rate.
Total cost. Okay.
Yeah, and the key thing here is that it's not just the interest rate. It also wraps in all those other fees and charges the lender might add on. It's like the all-inclusive yearly price tag for the loan.
Ah, okay. So like the sticker price plus all the little, admin fees and stuff they tack on.
Exactly. Things like origination fees, processing fees, basically any mandatory costs you have to pay just to get the loan finalized.
Okay.
And importantly, in many places, lenders are actually legally required to tell you the APR. It's not some secret number they can hide.
That's good to know. Some transparency baked in.
Definitely. And that legal requirement, it's there for a really good reason. It allows you, the borrower, to make a much more accurate comparison, like apples to apples,
Right.
between different loan offers. Because if you're only looking at interest rates, you could easily miss that a loan with a slightly higher rate might actually be cheaper overall if it has much lower fees.
Okay. Right. So the big takeaway here feels like always compare loans using the APR, not just the interest rate, because that gives you the clearer picture of what you're really going to pay.
Exactly. The APR is your best tool for understanding the true cost. It brings all those potentially hidden fees out into the open.
Now, okay, the interest rate keeps popping up next to APR. Let's really nail down the difference. What is the interest rate just on its own?
Right. So the interest rate is, let's call it the basic cost of borrowing the principal amount.
The principal being the actual cash you're borrowing.
Correct. The sum you take out, it's a percentage, and it's basically the fee the lender charges just for letting you use their money. Now, this is key. The interest rate doesn't include any of those extra fees we just talked about.
Okay.
And it's also worth remembering, an interest rate can be fixed, stays the same, or variable, meaning it can change over time, usually based on market conditions.
Right. So the interest rate is sort of the bare bones cost, and then the APR layers and all the extras.
That's a really clear way to put it, yes. The APR, like we said, always includes the interest rate. It's the interest rate plus all those other mandatory costs tied to getting the loan. And because of those extra costs, the APR will almost always be higher than just the interest rate number you see advertised.
Makes sense.
Again, just to stress it, the APR is that legally required figure that really helps you compare different loan offers fairly.
So going back to Michael's car loan, that 3.9% interest rate sounded good, but the 5.2% APR really showed the total expense once you factored in all the paperwork and fees.
Precisely. Yeah. And let's use another example to really hammer this home. Imagine a $20,000 car loan. Lender A quotes you 4.5% interest.
Okay, sounds reasonable.
Seems okay. But then you dig into the details, maybe the fine print, and you find $500 in various fees, processing, application, whatever.
Right.
When you factor those fees in, calculate the total cost as an annual percentage. Suddenly the APR jumps to, say, 5.2%.
Ah, just like Michael's.
Yeah. That seemingly small difference reveals a significantly higher true cost. It's kind of like finding out the shipping and handling on that great online deal is actually, really expensive.
Huh? Yeah, that analogy clicks. It's like the difference between the shelf price and what you actually pay at the till after tax and everything else.
Exactly. You need to see that final out-the-door price for the loan, and that's what the APR is designed to show you.
All right, solid handle on APR interest rates.
Yeah.
Now, another term you hear a lot is loan term. What exactly does that mean?
The loan term is simply the amount of time you have to repay the loan completely.
Okay, how long you've got?
Yep. Could be short, just a few months for maybe a small personal loan, or it could be decades, like for a mortgage. It's
Yeah.
just the agreed upon schedule for paying back the money.
And different types of loans usually have sort of standard term lengths, right?
Absolutely. Like with car loans, you often see terms like 36 months, 48 months, 60 months. That's 3, 4, 5 years.
Mm-hmm.
For mortgages, 15-year and 30-year terms are very common. The type of loan and, how much you're borrowing usually dictates the typical repayment periods you'll see offered.
Okay, so the term is how long you're making payments. But how does that length of time actually affect what you end up paying in total?
This is where it gets really interesting.
Yeah.
And where, honestly, a lot of people can get tripped up. The loan term has a huge impact on both your monthly payments and the total cost of the loan over its whole life.
Okay.
Generally speaking, there's kind of an inverse relationship going on.
Okay, break that down for us. Inverse relationship.
Sure. So a longer loan term, that usually means lower monthly payments.
Right. Which sounds good.
It does. It can make the loan seem more affordable day to day, easier to fit into the budget. However, and this is the big catch, because you're spreading repayment out over more time.
You're paying interest for longer.
Exactly. You're accruing and paying interest for a much longer period. And this ultimately means you pay a significantly higher total amount of interest over the entire life of the loan.
So less each month, but for way more months, means you shell out more overall in interest.
Precisely. Now, flip that. If you choose a shorter loan term, your monthly payments will be higher.
Right.
No way around that. You're paying back the principal faster.
Okay.
But the big advantage, you'll pay considerably less interest in total because you're just not borrowing the money for as long. You get out of debt quicker, reduce the overall cost.
So it really sounds like a balancing act. Lower payments now versus a lower total cost later. How do you even decide which way to lean?
That's a really crucial question.
Yeah.
And the answer, it honestly depends entirely on your specific financial situation and your longer-term goals.
Right.
You have to look hard at your current monthly budget. What can you genuinely afford without, stretching yourself too thin? But just as important, you need to consider that total cost. How much extra are you willing to pay in interest just to get that lower monthly payment?
So yeah, definitely not a one-size-fits-all thing.
Not at all. It's a classic trade-off. Immediate affordability versus long-term expense.
Can you give us another example, maybe with some numbers, just to really show how the term changes the total cost?
Absolutely. Let's take a, say, $10,000 loan at 5% interest. Simple numbers.
Okay.
If you choose a 3-year term, that's 36 months, your monthly payment would be roughly $300, give or take. And the total amount you'd pay back over those 3 years, about $10,800.
Okay, so $800 in interest over 3 years. Not nothing.
Right. Now let's stretch it out. Same $10,000 loan, same 5% rate, but this time a 5-year term, 60 months. Your monthly payments drop quite a bit, down to around $189.
Ah, that looks much more manageable month to month.
It does, but over those 5 years, you'd end up paying a total of about $11,340.
Whoa. So that lower payment cost you an extra $540 in interest compared to the 3-year term. $11,340, $10,800.
Exactly. That difference really starts to add up.
Yeah.
And just to take it one step further, what if you went for a 7-year term? The monthly payment drops again, maybe to around $141.
Sounds great. Right.
Super low payment. But the total amount repaid, it climbs to roughly $11,844. That means you'd pay almost $1,844 in interest, more than double what you'd pay with the 3-year term.
Wow. That really drives it home. How that small monthly difference explodes into a huge increase in the total cost.
It's a powerful illustration. It really makes you think twice about just grabbing the lowest payment, doesn't it?
It definitely does. Highlights those long-term consequences.
Exactly. So when you're looking at a loan, please don't just fixate on that monthly number. Step back. Think about how long you'll be paying and how much more you'll ultimately pay in total interest over that entire term. It's a crucial piece of the puzzle.
Okay, we've hit APR, interest rate, loan term. Now there's this other term I've heard, sounds a bit technical. Amortization. What's the main idea there?
Amortization.
Yeah.
Yeah, it sounds complex, but the concept is pretty straightforward. It's just the process of paying off your debt over time through those regular scheduled payments. What's interesting, though, is how each payment gets divided up. With most loans, especially early on, a bigger chunk of your payment goes towards paying the interest that's built up.
Right.
The rest of the payment, the smaller part initially, goes towards reducing the principal, that original amount you borrowed.
So wait, even if my payment amount stays the same each month, where that money actually goes, that changes over time.
Precisely. In the beginning, you're paying mostly for the privilege of having borrowed the money that's the interest.
Okay.
As you keep making payments month after month, year after year, a bigger and bigger portion of each payment starts going towards chipping away at the actual debt, the principal. It's like the balance shifts over the life of the loan.
That makes sense. So like in the first few years of a really long loan, you're barely making a dent in the actual amount you borrowed.
That's often exactly right, especially with things like mortgages, those really long-term loans.
Uh-huh.
Let's use a big example. Imagine a $200,000 mortgage, maybe 4% interest, 30-year term. On your very first monthly payment, it might be split roughly 50-50. Maybe, say, $667 goes to interest and $667 goes to principal. Just rough numbers.
Okay, pretty even split at the start.
But now, fast forward almost 30 years, you're making your very last payment. Almost all of that payment, maybe like $3,334 lie, would go towards paying off the last bit of principal and the interest portion. It might be just a few cents or practically zero.
Wow, that's a huge shift. So early on, you're mostly paying the cost of the loan, and only later do you really start tackling the debt itself.
That's a great way to think about it. And your lender has to give you something called an amortization schedule. It shows exactly this, how each payment breaks down month by month over the whole loan.
Ah.
You can also find tons of amortization calculators and charts online. They visually show how that split between principal and interest changes. It can be really eye-opening to see it laid out.
Yeah, I can see how understanding amortization gives you a much clearer picture of how you're actually paying down your debt.
It absolutely does. And it also helps explain something important. Why making extra payments, especially early in the loan,
Oh,
even small ones, can have such a big impact on reducing your total interest paid. Because more of that extra money goes straight to principal when the principal balance is still high.
That's a fantastic insight. Every extra dollar early on really works harder for you.
It does. Now, speaking of understanding things,
Right.
it's also really important to note there are legal protections for borrowers.
Right.
A key piece of legislation here is the Truth in Lending Act, usually just called TILA.
TILA. Okay. What are the main things you should know about TILA?
Well, TILA has several really important requirements, all designed to make things clearer and protect borrowers. First, as we've already talked about quite a bit, lenders must clearly disclose the annual percentage rate, the APR.
Okay, so that legal requirement we mentioned, that comes from TILA.
Yes, that's a core part of it. Second, TILA says all the fees and charges tied to the loan have to be clearly stated, right there in the loan agreement.
No hidden fees buried in tiny print.
Ideally, yes, that's the goal. No surprises. Third, TILA gives borrowers the right to cancel certain kinds of loans, like home equity lines of credit, for example, within a few days after signing. It's a cooling off period.
Oh, interesting. A chance to change your mind.
Exactly. Gives you a moment to reconsider. And finally, TILA includes rules to protect borrowers against unfair or deceptive lending practices. It sets standards for how lenders need to behave.
So it's really about making sure lenders are upfront, honest about the deal, and providing some safety nets for borrowers.
That sums it up well. TILA aims to level the playing field a bit, give borrowers the essential info they need to make informed decisions, and avoid, predatory stuff.
That's really good to know it exists. Okay, so we've covered a lot of ground thinking about all this. What are some key, expert tips you'd give someone who's about to take out a loan?
Okay, number one, absolutely crucial. Carefully, thoroughly read that Truth in Lending Act disclosure document. Don't just skim it. It has all the critical details. APR, fees, payment schedule, your rights. Make absolutely sure you understand everything before you sign.
Read it like your financial future depends on it, because, well, it kind of does.
Exactly. Second, and yeah, we're repeating this, but it's vital, compare APRs from multiple lenders. Don't just look at the interest rate.
Shop around, don't take the first offer.
Right. Get a few quotes. Third, When you're comparing those offers, always think about the total cost of the loan over the entire term, not just how nice that low monthly payment looks right now.
Remember the long-term impact.
Yes, as we saw with the loan term examples, that lower payment can end up costing you a lot more in the long run. Think about the whole financial commitment.
Got it.
Fourth, never ever hesitate to ask the lender direct questions about any fee before you sign. If something isn't clear, if you don't get what a charge is for, demand clarification.
Be assertive. It's your money.
Absolutely. You need to know exactly what you're paying for besides the interest. Transparency is key. And finally, seems obvious, but seriously, keep all your loan documents. File them somewhere safe. Keep them for the entire loan term. You might need to refer back if questions pop up or if there's ever a disagreement.
Solid, practical advice. Everyone should do that. Okay. How about we bust a few common myths people might have about borrowing?
Great idea. Myth number one, a really common one. The interest rate is all that really matters.
We know that's not true now.
Right. We've hammered this, but worth saying again. The APR gives you the full picture. It includes all those fees that can really bump up the total cost.
So don't get lured in just by a low interest rate number. Look deeper.
Exactly. Myth number two, longer loan terms are always better just because the monthly payment is lower.
We covered this too, the trade-off.
Precisely. While lower payments help the monthly budget, longer terms mean paying way more interest overall. It's not automatically better, it's just different with a significant long-term cost.
It's about weighing today's budget against tomorrow's total cost.
Well said. And a third one, all the fees are included in the interest rate.
Yeah, people might assume that.
They might, but it's usually not true. Things like origination fees, processing fees, they're often separate charges. They get factored into the APR calculation, but they aren't part of the base interest rate itself.
So never assume it's all bundled. Ask about all the fees specifically.
Absolutely. Knowing these distinctions can genuinely save you money and prevent some nasty surprises after you've already signed the papers.
Okay, fantastic information. Let's maybe hit a few specific questions someone might have. First one, how do I actually figure out the total cost of a loan? Like the total dollar amount?
Okay, the most direct way is to use the APR and the loan term. Figure out your monthly payment, multiply it by the total number of months in the term. That gives you the total amount you'll pay back.
Right, total paid.
Then just subtract the original amount you borrowed the principal, what's left over. That's your total cost of borrowing. Interest plus all the fees rolled into the APR.
Makes sense.
But honestly, there are tons of online loan calculators that do this for you. You plug in the loan amount, the APR, the term length, and bam, it tells you the monthly payment and the total cost.
Yeah.
Much easier.
Good tip. Use the tools available. Okay, next question. What kinds of fees are usually included in that APR calculation?
Generally, the APR is supposed to capture most of the mandatory charges you have to pay to get the loan in the first place.
Mandatory.
Yeah. So things like origination fees for processing the application, maybe underwriting fees for assessing the risk, other admin or processing fees, stuff you have to pay up front or rolled into the loan.
Okay.
But, and this is important, some potential fees might not be included in that initial APR, like late payment fees if you miss a payment down the road, or prepayment penalties if you try to pay the loan off early.
Oh, okay. So the APR covers the cost of getting the loan, but maybe not penalties for things that happen later.
That's a good way to think about it. So always ask about those potential extra costs too. Get the full picture of all possible charges.
Got it. Okay, last question, and this is one I bet a lot of people wonder about. Can I actually try to negotiate the APR the lender offers me?
Ooh, good question.
Yeah.
And the answer is often yes. You absolutely can and probably should try to negotiate.
Really?
Okay?
Yeah.
Your creditworthiness is huge here. If you've got a great credit score, a solid financial track record, you're less risky for the lender. That gives you leverage. You can push for a better interest rate, which directly lowers the APR. Also, remember what we said about shopping around?
Comparing offers from different lenders.
Exactly. If you get a better APR offer from lender B, you could take that back to lender A and say, hey, can you match this or beat it?
Use it as a bargaining chip.
Absolutely.
Yeah.
It shows you're serious, you've done your homework, and you're looking for the best deal. Don't be afraid to ask.
So definitely don't just accept the first number they throw at you. Advocate for yourself, especially with good credit and competing offers.
Precisely. It could save you a lot of money over the years you're paying back that loan.
Okay, Fantastic. Let's try and boil this down to some concrete actions. What's a clear action plan someone can follow to make sure they really understand the cost before they sign anything?
Okay, step one, absolutely non-negotiable. Compare the APRs. Get quotes from multiple lenders, banks, credit unions, online lenders before you decide.
Do your homework. Shop around properly.
Step two,
Mm.
calculate the total cost. Use an online calculator or do the math. Look at the total amount you'll pay over the whole term. Get past just the monthly payment number.
See the big picture cost, not just the small monthly slice.
Step three, review every single fee meticulously. Ask questions. What is this fee? Why is it this amount? Make sure you understand every single charge.
No shame in asking dumb questions about your own money.
Not at all. Step four,
Yeah.
read that TILA disclosure carefully. Understand your rights, understand the terms. It's designed to lay it all out for you.
Know what you're agreeing to legally.
And finally, step five, think critically about the loan term. How does the length you choose impact that total cost versus the monthly payment? Find the balance that works for your budget and your long-term financial health.
It's that trade-off again. Immediate affordability versus overall expense.
Exactly, making a conscious choice there.
Now, are there specific resources or tools people can easily find to help with all this?
Yes, definitely. Lots of helpful stuff online. We mentioned online APR calculators. Tons of financial websites have them. Super useful for quick checks.
Okay, easy to find.
Also, loan comparison tools. Many websites let you plug in your details and see offers side by side, comparing APR, fees, terms.
Great for seeing the options clearly.
Absolutely. And for solid info on the Truth in Lending Act and your rights, the Consumer Financial Protection Bureau, the CFPB, their website is an excellent, trustworthy resource.
CFPB, good government source.
Very reliable.
Yeah.
And lastly, just general financial education resources. Websites, nonprofits, even some good books. The more you learn about loans and finance in general, the better off you'll be.
Knowledge is power, especially when it comes to money.
Couldn't agree more.
So as we wrap up this deep dive, it feels like the main message, the core takeaway, is really about looking beyond that surface level monthly payment, right?
Absolutely.
It's about truly grasping the full, complete cost of borrowing money.
That's exactly it. Just focusing on the monthly payment, it can be incredibly deceptive. You have to factor in the APR, the loan term, all the fees to get that accurate picture of what you'll really pay over the whole life of the loan.
It's about shifting your focus, thinking about the total amount of money leaving your pocket by the time that loan is finally paid off.
Precisely. And if you invest just a bit of time up front, understanding these terms, doing your homework, comparing offers, you really empower yourself. You can make much smarter financial decisions and honestly save yourself potentially thousands of dollars.
So here's maybe a final thought for you, the listener, to chew on. How might really understanding the gap between just the interest rate and the all-in APR, how might that actually change the way you approach borrowing money in the future? Yeah.
And how might it change how you look at those financial offers that land in your mailbox or pop up online? Worth thinking about.
It really is. It's about making that mental shift, moving past just can I afford this payment to what's the real lifetime cost of this money.
Thanks for diving deep with us today. We really hope this has shed some light on the sometimes confusing world of borrowing.